Apart from retail, is there any other headwind that you would want to call out as we step into FY18?
From a vertical industry perspective, no. In fact, as you saw, when you saw BFS, retail, high-tech, which were the three weaker ones, high-tech, if you look at over the last 3 quarters, it is nicely picking up, and we think it's got the good trajectory to go through. BFSI, as we said, we are seeing a decent pipeline, and that should come through. So retail continues to be, from a vertical perspective, the one where there's a clear structural challenge. Communication is the first year that it has delivered 10% growth over the last 5 years, I think, if I am not mistaken. So we need to be a bit careful about it. There's a clear uptick in that, but likely to be a bit volatile, because as it comes off a low period, it's likely to be a bit volatile. But I think we are quite confident about what we're seeing there. From a geography perspective, again, the 2 big underperforming regions, which were UK and APAC, the structural challenges in them, which were driven by Diligenta and Japan, we are very, very constructive on Diligenta. Again, as NGS had mentioned earlier, a very strong pipeline with one which we expected to sign very shortly, in which case Diligenta should do quite well, and that should take care of the negative drag on UK. Japan has been a net negative year, and we expect it to be net positive in FY18, and that should continue to provide that support on APAC. So geography-wise also, we are not seeing any weakness in any specific region. Emerging markets are always volatile. So that it's part of the equation. In fact, going back to your question on India, we have never defocused on India. In fact, we have been the most invested in India. And the focus is to move from a project-based revenue streams to annuity-based revenue streams. And that's the key issue in most emerging markets. When you're on a project-based one, the volatility is very high. As you shift slowly into an annuity-based streams, you get more certainty into the revenue side. So that continues to be the focus in India as well.
Okay, so retail soft, you'll wait and watch on communication.
That's right.
And Japan is also may not be a phenomenal growth here, but it will not be a negative growth here.
That's right.
So these are the only sort of headwinds we could call out as we step into the next year. What about digital? In a way, do you think digital growth has slowed down? The reason I say that is in the prior years, you had about a 30% year-on-year growth in digital. In the last quarter, it was about a 22-23% year-on-year growth. Again, I'm not saying that the difference is very large, but in a way, do you think it's slowing down now that the size is getting bigger? And you also had given a number of $10 million in terms of a deal size. How do you see that progressing as the year?
Both in terms of digital for the full year FY17, we touched $3 billion in digital revenues in FY17, and that's up about 28-29% for the full year. So it continues to be growing far ahead of the company average and continues to power growth. And it's likely to continue that way with over time a slow moderation as it goes through the one.
So what would you classify as slow moderating growth for digital?
It used to be 50s earlier. It is in the 30s now. It's likely to be in the 20s.
FY18 will be in the 20s.
In the 20s. That will be a more natural expectation as the size becomes larger. And deal size wise, we had commented that in the context of BFSI, where we had said that digital projects are moving from the pure front end into the back-end part of relooking at core systems and re-architecting them for more digital-friendly kind of architectures. And that is increasing the deal size. So we are moving away from deals in the few millions to deals in the 10 million plus kind of range. And that again is a natural progression as the technology starts permeating deeper inside the enterprise for these large customers. And that's again a net positive for us as we look forward into the year.
I don't think you can ever give up the hat of a CFO as well. So I was reserving this question for Ramki, but I'm going to ask you, more on the margins as well. What gives you the confidence that you will be able to maintain it? You spoke about a few levers. One was, demand. Secondly, lower hiring. And thirdly was higher margins and newer technology. If you could elaborate how all three of them could incrementally contribute. What are the margins, say, in newer technology as you see? How much would the hiring be lower compared to the prior year?
So as you said, it's better to leave it to Ramki, but let me still think. Margin from newer technologies, a very interesting way of thinking about it is people have been talking a lot about pricing collapse, and we have been saying that net realizations are fairly stable and that comes from a portfolio mix strategy. So newer technologies typically come in at a better price point, but initially the better price point is married with a higher cost point also, because project sizes are small, they are more on-site centric, more touch intensive, more the pyramid is not optimized. And as we start increasing scale, all these levers come into play. The project sizes become much larger. Our delivery maturity in it keeps on increasing. So newer technologies definitely, as they scale up, provide margin support. And the other levers also that you mentioned, each of them are incrementally positive.
Okay, gentlemen, we've run out of time, but it's a pleasure having you, speak first to CNBC TV 18. Thanks again and all the best for the coming quarters. With that, Lata and Anuj, it's back to you in the studio.
Thanks a lot for that, Shima. It's good to see that there is maybe a little bit cautious, but still optimism